If you own physical gold or silver right now, I need you to listen very carefully to what I'm about to tell you. Because what's happening in the precious metals market isn't just unusual, it's unprecedented. And if you don't understand what's really going on behind the scenes, you could make a decision in the coming weeks that you'll regret for the rest of your life. Let me start with something that should terrify every paper gold holder on the planet. The COMEX, the world's largest metals exchange, is showing signs of stress that veteran traders haven't seen in decades. We're talking about a market structure that's been in place since the 1970s, starting to crack at the seams. And when I say crack, I mean fundamental breaks in how this market is supposed to function. Here's what's happening. Silver lease rates, which measure how much it costs to borrow physical silver for delivery, recently spiked to nearly 40%. Let me put that in perspective. Normal lease rates hover around 1–2%. During the 2008 financial crisis, they hit maybe 5–6%. We're now seeing rates that are 8 times higher than a major financial crisis. That's not a red flag. That's a 5-alarm fire. But it gets worse. The COMEX has been trading gold contracts at substantial discounts to London spot prices. Think about that for a second. Gold is gold, right? An ounce in New York should be worth the same as an ounce in London. But it's not. The COMEX, which is supposed to be the price discovery mechanism for the entire world, is trading at a discount. That only happens when there's a delivery problem. When the people holding paper contracts start to worry, they might not actually get their metal. Now, I know what some of you are thinking. This is just market volatility. Prices go up and down. But this isn't about price. This is about the physical metal itself becoming scarce in a market that's supposed to have plenty of it. And that scarcity is creating something called backwardation, which is a fancy way of saying that getting metal today costs more than getting it in the future. In a normal market, that's backwards. Future delivery should cost more because of storage and insurance costs. But when the market flips, when immediate delivery commands a premium, that tells you one thing. There's not enough physical metal to go around right now. Let me tell you a story that illustrates exactly what's happening. There's a major silver dealer, one of the largest in North America, who recently stopped taking orders. Just stopped. Not because they didn't want business, not because they were restructuring. They literally couldn't source enough physical silver to fulfill orders. Think about that. A dealer whose entire business model is buying and selling silver can't get silver. That's like a gas station running out of gas. It doesn't happen unless something is fundamentally broken in the supply chain. And this isn't isolated. Premiums on physical silver coins and bars have exploded. We're seeing premiums of 30%, 40%, even 50% over spot price in some cases. That means if silver is trading at $30 an ounce on paper, you're paying $45 for a physical coin. Why? Because there's a massive disconnect between the paper market and the physical market. The paper market says there's plenty of silver. The physical market is screaming that there isn't. Now let's talk about what's driving this. Because it's not just one thing. It's a perfect storm of factors that are all converging at the same time. First, industrial demand for silver is at all-time highs. Solar panels alone are consuming over 200 million ounces of silver per year, and that number is growing by double digits annually. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments around the world are pushing, it's incredibly silver-intensive. And here's the kicker. Unlike investment demand, which can reverse, industrial demand destroys silver. Once it's in a solar panel or a circuit board, it's gone. It's not coming back to the market. Second, mine supply is constrained. Silver production peaked years ago, and despite higher prices, we're not seeing a surge in new supply. Why? Because most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just decide to mine more silver. You'd have to mine more of these other metals, and those markets have their own supply and demand dynamics. Plus, it takes 7 to 10 years to bring a new mine online. Even if companies started today, we wouldn't see that supply until the early 2030s. Third, and this is huge, central banks have completely changed their behavior. For decades, central banks were net sellers of gold. They were dumping their reserves, convinced that gold was a barbarous relic with no place in a modern financial system. But something shifted. Starting around 2010, central banks became net buyers, and not just modest buyers. We're talking about record purchases year after year. In recent years, central banks have been buying over 1,000 tons of gold annually. That's roughly 30% of total mine supply just being absorbed by central banks. Why the change? Because they see what's coming. They understand that the dollar-dominated system that's been in place since World War II is under stress. They're watching the U.S. national debt explode past $36 trillion. They're seeing the Federal Reserve's balance sheet balloon to levels that would have been unthinkable a generation ago. They're witnessing the weaponization of the dollar through sanctions and financial restrictions. And they're quietly, methodically, diversifying away from dollar reserves into gold. Look at what China is doing. Official numbers show they've been adding to their gold reserves consistently, but many analysts believe the real number is much higher. China has a stated goal of reducing dollar dependence. They're not going to announce their full gold holdings because that would tip their hand. But the evidence is everywhere. Chinese gold imports through Hong Kong, domestic mine production that never leaves the country, the Shanghai Gold Exchange becoming a major price discovery mechanism. China is accumulating gold on a scale that's hard to comprehend. Russia did the same thing before sanctions hit. They massively increased their gold reserves while reducing their treasury holdings. When Western sanctions froze Russian dollar reserves, their gold remained untouchable. That lesson wasn't lost on other countries. If you're a central bank in Turkey, India, Brazil, or anywhere else that might find itself on the wrong side of U.S. foreign policy, you're thinking very carefully about how much of your reserves you want in dollars versus gold. And then there's the BRICS nations: Brazil, Russia, India, China, South Africa, and now a growing list of countries wanting to join. They're openly discussing alternatives to the dollar for international trade. They're talking about a gold-backed trade currency. Whether that actually happens or not is almost beside the point. The fact that major economies are even having these conversations shows how much the landscape has shifted. Now, here's where this gets personal for anyone holding retirement accounts. Because everything I've just described, all these macro forces, they're creating an environment where physical precious metals could become one of the most important wealth preservation tools available. And I'm not talking about speculation or trying to get rich quick. I'm talking about protecting what you've already built. Think about your retirement account for a second. If you're like most people, it's heavily weighted towards stocks and bonds, maybe some mutual funds, all denominated in dollars, all subject to the same systemic risks. If the dollar weakens significantly, your purchasing power declines. If the stock market corrects, your account value drops. If bond yields spike because of inflation or debt concerns, your bond holdings lose value. You're essentially concentrated in one system, one currency, one set of risks. Now, I'm not saying to abandon traditional investments, but diversification means actually diversifying, not just owning different stocks. And one of the ways sophisticated investors and institutions diversify is by holding physical precious metals. The challenge is that most people don't realize you can hold physical gold and silver inside a retirement account. It's called a gold IRA, and it allows you to get actual physical metal stored in a secure vault while maintaining the tax advantages of a traditional IRA. I put together a comprehensive guide on how this works. It's completely free, and you'll find it in the description below. It covers the mechanics of rolling over existing retirement funds, the types of metals that qualify, the storage requirements, and the tax implications. If you have $100,000 or more in retirement accounts and you're concerned about the things we're discussing, it's worth taking a look. No pressure, no sales pitch. Just information so you can make an informed decision about whether this makes sense for your situation. All right, back to what's happening in the markets right now. Because the supply squeeze we're seeing isn't just about industrial demand and central bank buying. There's another layer to this that most people don't understand, and it has to do with how the paper gold and silver markets actually work. The COMEX operates on a fractional reserve system. That means for every ounce of physical gold or silver in the vaults, there are multiple paper claims on that same ounce. It's similar to how banks operate. They don't keep all your deposits in cash in the vault. They lend most of it out, keeping just a fraction in reserve. The system works as long as not everyone asks for their money at the same time. The same principle applies to the COMEX. The system works as long as most contract holders settle in cash rather than taking physical delivery. And historically, that's exactly what happened. Less than 1% of contracts resulted in physical delivery. The COMEX was primarily a price discovery and hedging mechanism, not a physical delivery system. But something has changed. Delivery requests have been increasing. More and more contract holders are standing for delivery, demanding physical metal instead of cash settlement. And the COMEX is struggling to meet that demand. That's why we're seeing these unusual market signals. The discounts to London prices, the backwardation, the stress in the lease markets. These are all symptoms of a system that's being pushed beyond its design limits. And here's the really interesting part. The big players know this. Sophisticated institutions, hedge funds, and wealthy individuals are quietly positioning themselves. They're not waiting for the mainstream media to report on it. They're not waiting for their financial advisors to recommend it. They're looking at the same data we're looking at, and they're acting. Look at what's happening with silver ETFs. For years, these funds were accumulating metal. Investors were piling in, and the ETFs were buying physical silver to back their shares. But recently, we've seen outflows from some of these funds. Does that mean demand for silver is declining? Not at all. What's happening is that sophisticated investors are moving from paper silver, even ETF silver, to physical silver in their own possession. They want direct ownership, not a claim on a fund that holds silver. They want to eliminate counterparty risk. This is a crucial distinction. When you own shares in a silver ETF, you don't own silver. You own shares in a fund that owns silver. There are layers of intermediaries between you and the metal. If there's a systemic crisis, if there are delivery failures, if there are legal disputes about who owns what, you're in line with everyone else holding claims. But if you own physical metal in your possession or in allocated storage in your name, you have direct ownership, no counterparty risk. No one else has a claim on your metal. Now let me take you back in history for a moment, because what we're seeing today has parallels to previous precious metals bull markets. And understanding those parallels can help you understand what might be coming. In 1971, President Nixon closed the gold window, ending the direct convertibility of dollars to gold. That kicked off a massive bull market in precious metals. Gold went from $35 an ounce to over $800 by 1980. Silver went from $150 to $50. But it wasn't a straight line. There were corrections, consolidations, periods where it seemed like the rally was over. And at each of those points, people who sold lived to regret it. I want to tell you about a man named Jerome Smith. He was a financial advisor in the 1970s who understood what was happening with the dollar. He told his clients to buy gold when it was $35 an ounce. Many did. But as gold rose to $100, then $200, then $300, some of those clients got nervous. They'd made good profits. They wanted to lock in gains. They sold. And they watched in agony as gold continued to $800. The ones who held on, who understood the fundamental drivers, they saw life-changing returns. The same thing happened in the 2000s. Gold bottomed around $250 in 1999. By 2008, it was at $1,000. A lot of people sold, thinking that was the top. But gold wasn't done. It went to $1,900 by 2011. The people who sold at $1,000 missed out on another 90% gain. Here's the lesson. In a real precious metals bull market, driven by fundamental factors like currency debasement, supply constraints, and geopolitical instability, the moves are much larger than most people expect. And the biggest mistake you can make is selling too early because you're thinking in terms of normal market cycles. What we're experiencing now has all the hallmarks of a major bull market. The fundamentals are arguably stronger than they were in the 1970s or 2000s. The debt levels are higher. The money printing is more extreme. The geopolitical tensions are more severe. The supply constraints are more acute. And yet, we're still in the early stages. Gold has made new highs, yes, but relative to the money supply, relative to total debt, relative to the stock market, gold is nowhere near the levels it reached in previous peaks. In 1980, gold hit $800 an ounce when the U.S. national debt was less than $1 trillion. Today, the debt is over $36 trillion, and gold is around $2,000. If you adjust for the increase in debt alone, gold should be over $28,000 an ounce to match its 1980 peak. Now, I'm not predicting gold will hit $28,000, But I'm showing you that relative to the fundamental drivers, we're not in bubble territory. We're not even close to the kind of extremes that marked previous tops. Silver is even more compelling. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been hovering around 80.1. Historically, that ratio has been much lower. In 2011, it got down to 30.1. In 1980, it briefly hit 15.1. If silver just returns to a 50.1 ratio with gold at current levels, silver would be over $40 an ounce. If it hits 30.1, we're talking about $65 or $70 silver. And if we see the kind of supply squeeze that some analysts are predicting, the ratio could go even lower. But here's what you need to understand. These moves don't happen in a vacuum. They happen because of real-world events that shake confidence in the financial system. And we're seeing those events unfold right now. The banking crisis earlier this year was a warning shot. Silicon Valley Bank, Signature Bank, First Republic, all failed in rapid succession. The Federal Reserve had to step in with emergency lending facilities. Depositors panicked, and for a brief moment, the curtain was pulled back on how fragile the banking system really is. Banks are leveraged institutions. They borrow short and lend long. When depositors lose confidence and start withdrawing funds, the whole system can seize up very quickly. Now, the immediate crisis was contained. The Fed provided liquidity, regulators arranged mergers, and things stabilized. But the underlying problems didn't go away. Banks are still sitting on massive unrealized losses in their bond portfolios because interest rates rose so quickly. Commercial real estate is under pressure with remote work reducing office demand, and the Fed is caught between fighting inflation and supporting the financial system. Every time they raise rates to combat inflation, they put more stress on banks and borrowers. Every time they pause or cut rates, they risk letting inflation get out of control. This is the environment where gold and silver thrive, not because precious metals investors are rooting for chaos, but because metals are the ultimate safe haven when confidence in the financial system wavers. They're no one's liability. They can't be printed. They can't be debased. They've been money for thousands of years, and they'll still be money long after today's fiat currencies are forgotten. And that brings me to the most important point I want to make. If you own physical gold and silver right now, you're holding something that's becoming increasingly scarce at a time when demand is accelerating. You're holding an asset that central banks are accumulating. You're holding protection against currency debasement, financial instability, and geopolitical chaos. And you're holding something that, if the supply squeeze continues, could see price appreciation that makes today's levels look cheap in hindsight. So, when I say don't sell a single ounce, I'm not being hyperbolic. I'm looking at the same data that central banks are looking at. I'm seeing the same supply constraints that are causing dealers to stop taking orders. I'm watching the same market structure stress that's creating backwardation and extreme lease rates. And I'm telling you that this is not the time to be taking chips off the table. Now, I know there are always reasons to sell. Maybe you need cash for an emergency. Maybe you're rebalancing your portfolio. Maybe you're taking some profits after a nice run. I get it. Life happens. And sometimes you need liquidity. But if you're selling because you think metals have had their run, or because you're worried about a correction, or because someone told you it's time to get out, I'm urging you to reconsider. Look at what the smart money is doing. Look at what central banks are doing. Look at what's happening in the physical markets. And ask yourself, do these look like the actions of people who think the precious metals bull market is over? Or do they look like the actions of people who are positioning for something much bigger? There's a concept in investing called strong hands versus weak hands. Weak hands are the people who buy high and sell low. They get excited when prices are rising and everyone's talking about an asset. They panic when prices correct and sell at the bottom. Strong hands are the opposite. They buy when no one's paying attention. They hold through volatility, and they only sell when the fundamentals change or when prices reach levels that reflect true overvaluation. Right now, you have the opportunity to be strong hands. You've already done the hard part. You've acquired physical metal. You've taken possession or arranged secure storage. You've removed yourself from the paper markets and the counterparty risks. You're holding real, tangible wealth. Don't give that up because of short-term price movements or because you're getting nervous. Remember, The people who made life-changing wealth in previous precious metals bull markets weren't the traders who tried to time every move. They were the holders who understood the big picture and had the conviction to stay invested through the volatility. They were the people who bought gold at $300 and held to $1,900. They were the people who bought silver at $5 and held to $50. They didn't sell at the first sign of profit. They held until the fundamentals changed. And here's the thing. The fundamentals haven't changed. If anything, they've gotten stronger. The debt is higher. The money printing is more extreme. The geopolitical tensions are more severe. The supply constraints are more acute. Every single factor that drives precious metals higher is still in place and intensifying. So what should you do? Hold. Hold fast. Hold through the volatility. Hold through the corrections. Hold through the periods where it seems like nothing's happening. Because in a real bull market, the biggest gains often come in the final stages. And you don't want to be the person who sold at $2,000 gold and watched it go to $3,000, $4,000 or higher. Now, if you don't own physical metals yet, or if you're looking to add to your position, the current environment actually presents an opportunity. Yes, prices are higher than they were a few years ago, but relative to where they're likely headed, relative to the fundamentals, relative to the supply constraints we're seeing, current prices could look like a bargain in hindsight. The key is to focus on physical metal, not paper proxies. Don't buy mining stocks thinking you're getting precious metals exposure. Mining stocks are equity investments with all the risks that entails. Don't buy ETFs thinking you're getting physical metal. You're getting a claim on a fund that holds metal, which is not the same thing. Buy actual physical coins and bars. Take delivery or arrange allocated storage in your name. Eliminate counterparty risk. Own the metal directly. And if you're concerned about the tax implications of buying outside a retirement account, that's where a gold IRA can make sense. You get the benefits of physical ownership with the tax advantages of a retirement account. It's a powerful combination, especially if you're in your peak earning years and looking to protect wealth for retirement. But whether you're buying more or just holding what you have, the message is the same. This is not the time to be selling. This is the time to be patient, to be strong hands, to understand that what's happening in the precious metals markets is part of a much larger shift in the global financial system. We're watching the slow-motion collapse of the post-World War II monetary order. We're watching the dollar's role as the world's reserve currency being questioned for the first time in generations. We're watching central banks around the world diversify away from dollars and into gold. We're watching supply constraints in silver create a physical shortage in a market that's supposed to have plenty. We're watching the paper markets show signs of stress that veteran traders haven't seen in their entire careers. These are not normal times, and normal investment strategies don't apply. The playbook that worked for the last 40 years, the playbook that said buy stocks and bonds and hold dollars, that playbook was written for a different era. An era of dollar dominance, low inflation, and faith in central banks. That era is ending, and the new era will be defined by currency instability, inflation concerns, and a flight to real assets. Gold and silver are the ultimate real assets. They're no one's liability. They can't be printed or debased. They've been money for thousands of years. And in times of financial stress, they're where wealth flows for protection. So if you own physical metals, hold them. Hold them tight. Don't let short-term volatility shake you out. Don't let talking heads on TV convince you the bull market is over. Don't let fear or greed drive your decisions. Look at the fundamentals. Look at what's really happening in the markets and make your decision based on that. Because when you look at the fundamentals, when you see the supply constraints, the central bank buying, the industrial demand, the currency debasement, the geopolitical tensions, the banking system stress, all of it, there's only one rational conclusion. We're in the early stages of a major precious metals bull market, and the people who hold through this are going to be very glad they did. The choice is yours. You can be weak hands and sell at the first sign of trouble, or you can be strong hands and hold through the volatility, knowing that the fundamentals are on your side. You can panic when prices correct, or you can use those corrections to add to your position. You can listen to the mainstream financial media that's been wrong about precious metals for decades, or you can look at what the smart money is doing and follow their lead. I know what I'm doing. I'm holding. I'm holding every ounce. And I'm looking to add more on any significant pullbacks, because I understand that what we're witnessing is historic. It's a once-in-a-generation shift in the global financial system, and the people who position themselves correctly are going to preserve and grow their wealth in ways that most people won't believe until it's too late. Don't be most people. Be the person who saw what was coming and acted. Be the person who held when others panicked. Be the person who understood the fundamentals and had the conviction to stay invested. Be strong hands. Hold fast. And don't sell a single ounce.